Hello, welcome back to the video. My name is Andrew Kuhn, Focus Compounding, sitting next to Geoff Gannon, Focus Compounding. Jeff, how's it going? Say hi.
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 It's
going well. So in today's video on our IGTV, we're going to be talking about the proxy statement. I don't think we've ever actually dedicated a podcast to this topic, so maybe we'll have to do a more in-depth one. But explain what a proxy statement is, why it's important, and what you always look for when you, read it, when you're doing research on a company.
Right. So when I actually read about a company on Edgar, which is the SEC site for filings, SEC filings, I look at the 10K, the most recent 10K, the most recent 10Q, and also a proxy statement, which will be some form of the number 14 will be in the name. You can find it there. It's on the list. And it depends. There's some things a company can put in the 10K instead of putting it in there. But for most companies you're going to be looking at, especially if they're bigger companies and stuff, you're going to see it in the proxy statement. And it's basically going to be a notice of the annual meeting. And it's going to give you information about who owns what stock in the company. Is also going to give you information about the board. It'll give you information about compensation, about how it works, so bonus plans and things like that. We look at that a lot. So the first thing is just who the shareholders are and how much they own of it. That's the first one. And then the second one would be, we also spend a lot of time probably looking at how they're compensated, what the bonuses are.
Yeah. So, and I guess, what makes up that bonus? So is it more stock options? Is it more equity? Is it a cash bonus? What does that look like? How do they judge the performance?
That's
like,
for example, most about.
Is it like, are they judging it based on revenue growth? Are they judging it based on profitability or return on invested capital? Mm-hmm. I think like Tesla, for example, I think they're judging Elon Musk's bonus based on market cap.
Yep.
And what that market cap is, which, could be interesting. But what do you typically like to see? How do you like to see the CEO's bread buttered?
Just by owning a lot of stock would be the best way. But absent that, you were on the NACO earnings call, and you asked a question about something that's in that proxy statement. It's actually in the proxy statement that you can see it, that the payment for some, it's not a huge part of it, but there's payment for some stuff. The bonus is based on the return on tangible capital at a specific mine that they have.
Yeah.
And that's very helpful. That kind of thing is useful when you have unusual sorts of things about what how they compensate people. So like I was reading the Sydney Airport, which is not a proxy statement, it's just including their annual report because they're an Australian company. But it broke down that there's 3 sections. One is just discretion of the board, which is a very common way of doing these things. But the other 2 were total stockholder return, which is fine. And then the other one that was interesting is they target a certain level of cash flow growth. So they say explicitly that it is a aggressive target though, which is a suggestion that they're not guaranteeing they're going to hit it. Yeah. But they don't get anything from it unless they hit 8%. And then it maxes out at 12% growth in cash per share, cash flow per share, which are very high numbers. So that would suggest like an 8 to 12%. It's sort of like an 8 to 12% earnings per share growth rate target. Yeah.
Well, it's good that they're doing it on earnings too, not like revenue or some other metric that.
Yeah. In fact, it's more interesting that it's doing like a cash flow one because that's all they think in terms of that company. So it's helpful. And like the NACA one, it's helpful because they tie up a lot of capital in that mine. So it's good to know that they focus on that. But also like the NACA one actually. They don't say what the target is in percentage terms because they don't want to share that information with competitors. Yeah. And they also, as is true for some other companies, they may have, you'll see sometimes there's a project or something that people are being compensated on the success of it, but they will like keep some of it confidential. And so I think NACA has business development as one, which is like they're probably trying to win a new contract, but they won't tell you what contract it is. I've seen IT programs and things like that, same thing where they won't tell you what it is, but that 5% of the bonus to this person is going to be based on whether they succeed on this project.
And I think it's really good too if the way, like for example, if they talk about how return on capital is like a very important metric. Like when I was on the earnings call and I asked the CEO how they think about it, he pretty much said, well, I think return on capital has been, the most important metric that we've used ever since I've been here, and he's been there for 20 plus years. So really just kind of getting into the culture of the business, how they think about capital, how they think about returns, how they think about, I guess, shareholder capital is what's pretty useful. So I guess getting back to the proxy statement, I mean, you like to see the CEO and like top management own a bunch of stock.
Yes.
What else are you typically looking for in there?
Any relationships between them, how long they've been there, whether they would have sort of like who do I think is the most influential in the culture of the company and the capital allocation and things like that. Yeah. That sort of things. I was just reading about a company recently where like 3 different people at the top all came over about 30 years ago or so, and they've all been there. So even if that CEO were to leave or something, the other people have been there working with them for a very long time. So there'd be a lot of continuity and stuff. Yeah, family members, things like that. I was looking at one recently where it was the first transition away from basically being no family member of the original founding family, actually having like real day-to-day influence, even as chairman or something in the company. And that's always an interesting transition point and stuff. And that'll be covered in the Proxy Statement.
How much do you put into the types of funds or the types of firms that own the companies that you're looking at? Because if they own like a massive important part of the company, they're laid out in the Proxy Statement.
For an illiquid stock, I would put a lot of weight on it because they don't have an exit otherwise.
Yeah.
For a liquid stock, I wouldn't. But yeah. So I've looked at companies where they own 20 or 30%. A small value fund or something owns 20, 30%, and they have to push for a sale of the company because they're not going to get out.
Yeah, how else do you get out? Yeah. What do you think people should look for? And I guess when they're reading the Proxy Statements, or keep an eye out for?
I think that you should definitely look at compensation, what the targets are, and also literally what the numbers are. They usually will not include stuff that they know they have no hope of hitting. So like I was looking at a company and I thought that they might have trouble growing in the future and stuff, but their target is 3% growth per share in sales above inflation, so 3% real growth, which is that means they consider themselves still to be something of a growth company, even though they haven't really grown that fast in the last couple of years or something. And sometimes they'll adjust that down and change that. You know?
Yeah.
The really big things are if there's a huge change in how they're compensated. I've talked about this before, like Copart did this or something, where they had been paid with fairly normal sorts of base salaries and things, and then suddenly they want to get a lot of stock options or something over a longer period of time. Also things about like whether the company wouldn't benefit so much from dividends. The management won't benefit so much from dividends. Like per share numbers, they might benefit from buying back the stock, but they won't benefit from paying the dividends. For some things, I've seen things where it explicitly tells you it's not adjusting for the fact that the dividends are being paid. On other times, there's things I've seen where it is adjusting for that fact, almost as if the stock price is being adjusted for the fact they're paying higher dividends. Yeah. So they don't have, disincentive to do that.
Got it. Cool. Well, that is Mr. Geoff and myself going over the Proxy Statement. Check out our podcast, 144 different episodes. Go to our website, focuscompound.com. We also manage capital for investors at Focus Compound Capital Management. See you in the next video.